Welcome to the Rigatoni Capital Podcast. I am your host, Colin. It is the morning of Friday, March 6th. I got a late start here, so I got to rush through this. I was up late last night trying to figure out how to make a better thumbnail. So I decided to ditch my logo, Rigatoni Capital. It said Rigatoni Capital Podcast. That's my logo, but I was doing that for all my thumbnails. So I changed that and I ended up staying up late watching James Bond older movies on Netflix. They have the James Bond collection. So I woke up early and then I went back to sleep, very groggy. But that's why I have my Starbucks cold brew, which I have every morning. U.S. lost 92,000 jobs in February. A shocking U.S. jobs contraction. The U.S. economy unexpectedly shedded 92,000 jobs in February, a massive miss compared to economists' expectations of 50,000 plus. And here's the photo if you're looking at the screen, how the good days of adding jobs are long behind us. And people will blame this on AI, white collar job losses. People will blame this on the Fed. People will blame this on the Fed as in higher interest rates. People will blame this on a slowing economy. And people will blame this on Trump. People blame this on oil surging, which is now at 87 a barrel. Brent crude actually rose 89 per barrel. And WTI crude has surged to 86, 87 last time I looked on the TV. So a few other things I want to mention here before we start, just so you get a setting. Oh, by the way, it's a very dark and gloomy, sad day here on Wall Street as well. Very, not really cold, not really windy, but it's still raining from yesterday. So it's very depressing and sad. The stock market needs a sunny day. Shipping routes suspended. Global shipping giants Maersk and Hapag-Lloyd have officially closed key shipping lanes in the Middle East as the U.S.-Iran conflict enters its seventh day. Trump proposes direct say in Iran leadership. Not that important right now, but SoftBank's $40 billion OpenAI loan. SoftBank is reportedly in talks for its largest ever dollar loan, up to $40 billion, to fund its massive investment in OpenAI. And as a reminder, yesterday, OpenAI came out with their newest model. And I actually used it last night, to be honest with you. I didn't notice any difference, of course, because I'm not coding or anything. Where would I find that? Well, we'll look for that later. I think it's called 5.4 or something, or 5.2, the latest model. So yeah, anyway, there will be Kramer was on at 9 a.m. this morning, and I really do have to go soon because I'm late. But Kramer was on this morning and saying it's happening now. It's happening now. It's AI. It's taking all of our jobs. And people are laying everybody off in the white collar world. Blah 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 blah. I'll have to talk to Jensen Wong next time I see him. I think that's supposed to entertain you, and I think it's supposed to cause a little bit of fear. At the same time, I do believe AI is going to take a certain amount of jobs. I just don't know if looking at this number, we can blame it on AI today. I think this is going to be a story that continues to go on a little bit longer before we can claim it's white collar job loss, AI job loss. I do believe it's an issue, but I don't know if it's an issue right today. And I also think that we can add more jobs as well in the meantime in other sectors as well. So I'm not too upset about the revisions down. December gets revised down, and then January got revised down as well. And then you had this number in February that was bad. Okay, so what I wanted to talk about was long-term investing. That's what this show's about. Before I talk about that, I am going to tell you that on Substack, algotraderalert.com gives a daily stock market update every single day, super consistent. I refer to it every day. This is an example. If you're looking at my screen of what I look at, it gives you the end of day recap. And it's really short, which I like. And I recommend anybody check out Algo Trader Alert. Let's go to his page. It's at Algo Trade Alert. And he does a daily stock market update. And really what I would recommend going to in terms of just getting your recap of everything that happened. And the recap is good. I wouldn't steer you in the wrong direction. All right. So I wanted to show you a chart of Costco. Here's Costco's earnings from last night. I did not listen to the earnings report, the earnings call, but I want to show you total revenues, consolidated net income, free cash flow, and then operating margin. And I'm showing you how these companies are these big retailers, Costco, Walmart, they don't make a lot of margin, but their stocks are trading at a very high valuation. And that's just how it goes. That's what the market rewards consistency, some ARR on their subscriptions, their annual Costco subscription or their annual Costco card that you buy, and they can increase that fee and keep up with inflation. But let me show you something. I'm going to show you a forward valuation of Costco. Their forward PE for the next 12 months is 47 times. So I'm just pointing that out. Peter Lynch was interviewed on a podcast, or I guess he was on stage with Josh Brown many months ago, and it was one of his first appearances back in the public. And he had mentioned, I'm scratching my head here why something Apple, or no, what was he saying? Google trades at a low 20 valuation at that time before it made its epic run. I'm using Google as an example. I don't know what he said exactly, but what he was trying to say was Costco, Walmart trading at such high valuations does not make sense to him. These valuations got flipped from these big mega cap growth tech stocks to these lower growth stocks at Costco, but Costco's growing, so it's not they're not growing, but they're not growing as much as some of the tech companies that are trading at lower valuations. That's my point. Costco's very expensive, and even though it seems safe, it's Costco, it's a blue chip name. That doesn't mean you have to buy it. Doesn't mean you have to feel you have FOMO when the stock goes up. And to be honest with you, I don't own any retailers to my knowledge. I own Amazon, and I like Amazon because they have higher margin today. That wasn't always that. They lost money. They had very low margins, and but they make more margin than the normal retailer, the old brick and mortar retailer. Amazon somehow found a way to make higher margins. Isn't that crazy? Their operating margins are higher. Amazon can make 8 to 10% on their retail division business sometimes, and that's a margin. And Kroger, Costco, I'm not sure about Walmart. The only are making 3%, 4%, right? The only retailer that seems to have a somewhat interesting higher margin was a Home Depot or something last time I checked, but it's in between the two. And we can look at Home Depot another time. I actually do own a little bit of Home Depot. So I have Amazon, Home Depot as my retailers. I don't really have any other retailers that I can think of. And definitely cool people that bought and hold Costco when the stock was lower and they held it for the last 20 years. Definitely respect everybody that's still holding it while the stock is trading maybe above its intrinsic value. That's the whole point of a long-term value investor. That's the Bill Ackman approach, is don't be so concerned about trimming your winners. You buy it below its intrinsic value and then you hold it even when it's above its intrinsic value. That's the whole point of being a long-term buy and hold investor, to compound your wealth. And that's what I teach you here on my Substack and everything. Michael Burry last night was on Substack, and he was writing a few notes. Just want to mention this. He noted the Korean market is not very accessible to individuals. It is a market that has been ignored for years. Some momentum got into it. Those were institutions doing that to the KOSPI the last month or so. And that volatility is the cardinal sign that momentum traders have arrived. So what are institutions doing day trading what are institutions doing day trading the KOSPI? That is one horse of the apocalypse right there. So he's saying the institutions pumped it up. Maybe that's how I'm understanding it, right? But I don't know. Even if that's true, I don't know if I'm bearish Korean or Korea stocks. We can look at the KOSPI right now and see what it did overnight since nobody's really talking about it. People forgot already. People forgot already. It was flat. Last night it was flat. See how it bounced here and came up. Excuse me. Another thing I don't know if I mentioned, no, I did mention it about the semiconductors or something about 20% of the oil that goes to the Strait of Hormuz. A lot of that does go to China and everything. 90% of China's imports come from Iran. But there is an energy issue in Korea that is impacted by this war. And if they don't have the energy to fuel data centers or semiconductor plants, stuff or the actual raw materials, it was very confusing. I just think a lot of it is headline hype, to be honest with you. And obviously, KOSPI is really big. It looks a bubble because the largest holdings are Samsung and SK Hynix, and that's it. There's really only they probably make up for a very large percentage. If it was here in the U.S., people would be screaming bubble bubble, but in Korea, people weren't paying attention as much, I think, globally, and those two stocks got out of whack. And I still Korean stocks, but in a broader index portfolio. So I always have been recommending the ticker FRDM, Freedom 100. The Freedom 100 is down a lot. The only problem with entering into Freedom 100 emerging ETF today, and remember, Freedom 100 is the top 100 stocks in the freest countries. It has a market cap weighted, but it's not technically a market cap weighted. But you're pretty much buying Samsung right now, SK Hynix, Taiwan Semi, and then you have exposure to Chile and you have exposure to Poland, for example, and a few other countries. And I really love the ETF. I'll always hold it. Pays you a nice dividend. You have some rare earth material type of refiners down in Latin America. Super diversified, a really interesting fund. Anyway, I'm not going to talk about Freedom because I talk about it every single day. I'm not buying anymore. I have Freedom in another portfolio outside of my big Rigatoni Capital portfolio. I just wanted to let you know that now we're only trading below the 50-day. I mean, if I'm going to get really excited, I would like to see more of a pullback here because of this crazy run. But if we don't get a pullback, it's okay. I already own the ETF, and that is my international exposure. I have more international exposure to Freedom, which actually costs a 0.49% expense annual ratio. But I'm willing to pay that ratio. Back to Costco. Well, how did I get off the topic? Oh, yeah, we talked about Michael Burry. Last night, Excess Returns, which is one of my favorite podcasts. I am a subscriber, but I'm under a different YouTube name right now. It's called When Markets Say No More. Oh, Excess Returns. Excess Returns interviews famous investors and hedge fund managers and macroeconomists and well-known people you and I would know. Okay, famous people. And for some reason, they only have 65,000 subscribers. It's very odd. I guess my market's not that big, but I am their target market. There's no more of a target market than me. So I don't watch every podcast. They are long, about an hour each. But Rob Arnott was on the show and he discussed AI as either a bubble or boom, the positives of AI in the economy and investing, and the negatives of AI pretty much is what I took out of it. So instead of listening to the Costco earnings report, I listened to Rob Arnott. And just a reminder, Rob Arnott is a renowned investment manager, researcher, and the founder chairman of Research Affiliates, established in 2002. Often called the godfather of smart beta, he pioneered the fundamental index approach, which weights stock by economic size, sales, profits, dividends, rather than market cap. And yeah, he's been at it for a while. Really knowledgeable guy, really seems a really nice guy. So this came out last night. I recommend you all listen to it. It was an hour long. And then back in January 24th, I titled a post called Palantir is not an investment, it's a trade. Thoughts after Alex Karp's interview at Davos 2026. I wrote this on my Substack, but what sparked this idea was Rob Arnott was on the podcast Wealth Track. And Wealth Track is a different podcast that I listen to with investors. Definitely a shorter form than Excess Returns. It's a more 30-minute interview. And it's hosted by Consuelo Mack, and I think she's with Morgan Stanley or something. I don't know. But that was recorded on January 23rd. It sparked this thought process. Okay, this guy's smarter than me, obviously. And he definitely thinks that Palantir is a bubble. And what he says is he looks at the price to sales ratio of Palantir that's trading above 100. Palantir would need to achieve a compound annual growth rate of roughly 30 to 40% for the next 8 to 10 years to justify today's valuation. By the way, that's possible if their government type of demand is replicated into enterprise demand, and all of these big Fortune 500 companies need to have Palantir. It can technically grow that rate. What he's saying is, how do you justify a price that's 100 times sales? That's pretty aggressive. And so the company would have to, let's say, 50-fold growth. That's 50, not 50% in the coming 5 to 10 years in order to justify today's price. Is that possible? I suppose. Is it plausible? That's a little more of a stretch. So if it's not plausible, then it's a bubble by our definition. If you have to use implausible growth expectations to justify the current price, and if the marginal buyer doesn't care about valuation models, then you've got a bubble. And what he's saying is if Palantir does roughly $3 billion in revenue today, which they're doing over $4 billion, I believe, in annual revenue, and they're forecasted to do over $7 billion for the year 2026. So what he's saying is a 50-fold increase would imply about $150 billion in annual revenue in the future. That outcome would require growth closer to the high 40% range over a decade. That's an average over 10 years. So that's I say it's meaningfully above my 30 to 40% CAGR assumption. I think you get the point. I think if they were in the 30 to 40% CAGR for every year for 10 years, I think they would get to this 150 billion in annual revenue. It's probably implausible. He says, I agree with him. The stock is priced out of whack. And I think that if you do a discounted cash flow, is what he said last night, and your discounted cash flow is showing that the stock in the future would be trading, the stock target price is way higher than what you think it will be. And if it's implausible, like, is it possible? Sure. But is it, he says, what's the word he uses? Is it plausible? If it's not that plausible, then he thinks it's a bubble. And, he's not negative on AI or anything. He's actually bullish AI as a technology, but he thinks stocks like Palantir get out of whack, and I understand that. And I purchased Palantir as of Friday during his show. January 23rd is what I said. And go through my process of why I buy Palantir. It's not really, I'm not really sure if it's a very long-term investment with me. For example, if the stock traded to $200 a share, I would probably take some profits. That's not like me. I'm a buy and hold investor. You probably have seen my portfolio before. But if Palantir trades that high, yeah, I probably would take some profits. So it was kind of like a geopolitical trade idea for me. But I would love to own it long, if possible, long term if possible. But when Maduro was captured, I decided to finally squeeze my nose, buy Palantir. I think that there's demand for Palantir in terms of just an investment strategy, because there really is no disruptive AI software type of government and enterprise sector. Everything, and Alex Karp talks about this in his book and he preaches about it. But all these large mega cap companies are just selling ad space on digital apps. And all these large tech companies are really just trying to be consumer based. They're trying to target the consumer. They're trying to create technology and disruptive software and AI slot for the consumer. And Palantir was built on trying to defend from terrorism. So there's really not a lot of public stocks Palantir, and that's why I want exposure to it as something I'm trying to diversify into. Axon Enterprises is another example. There's really only two I know of, Palantir and Axon, that are these tech type of companies that aren't defense manufacturer industrials. And I think there's a demand for that in your portfolio. And I think there's a demand for this in the real world application. Anyway, I'll shut up about Palantir. You get my point. And I gotta go. I forgot I gotta go. John Ehrlichman posted 75 stock gainers this year. As you can see, SanDisk, the memory player, takes the lead at 139%. Year to date, I'm guessing. It says stock gainers this year. So we have to assume this is year to date. I wish people would do that. I wish people would say year to date or year over year or over 12 months. It's a shame they don't ever say that. So it's so confusing. Texas Pacific Land, the ultimate Halo stock, up 82%. Bloom Energy is up 81%. I don't believe that. I don't believe that, guys. I thought BE sold off. Did it not? If I go year to date, you think that's up 81% year to date? So did he mean over 12 months? Just don't get why people mess with us. Yeah, I guess he's right. Never mind. But it says it's up 72%. That's crazy. Over 12 months, Bloom Energy is up 576%. And then the photo floating around on X about that kid that made all this money buying calls or something on Harvard or some Harvard student. Okay, so anyway, we're not going to talk about this because we don't have time. Lockheed Martin up 35% year to date. Do you guys believe this? I think this is not accurate for some reason. Whatever. And then it shows comfort systems on that list. So I took a snapshot on my Robinhood app when I was on the couch last night. In the last 5 years, comfort systems is up 2,000%. Can you guys believe comfort systems is up 2,000%? I think it's a $49 billion market cap. Do you guys know comfort systems? And that made me think, how about Carrier Global Trading? Why isn't that stock doing well? And instead of going on fiscal.ai, if I just want to look at something quickly in terms of the revenue, and I go on TradingView and I scroll down to this income statement little graph, and it shows me annual. As you can see, their revenue is that just floating around 20 billion. It never grows. And that's interesting. I thought, and their net margins are a little bit lower than I thought. Carrier, which is the HVAC public stock, they're headquartered down in Florida, I believe. They have all the air conditioning companies that they probably have merged with over years, and then they went public, or then they spun off, who knows? But I just was interested in Carrier, but I don't think it's all that great of a stock. But that's the type of stock I'm looking at. When I see Comfort Systems is up a lot. Do you guys know what Comfort Systems does? Aren't they the electrician contractors and stuff? Comfort Systems is a nationwide provider of mechanical, electrical, and plumbing services, specializing in the design, installation, maintenance, and repair of HVAC. Okay, so let's look that company up and let me show you a Comfort Systems. Comfort Systems. Ticker's FIX. So this is a market cap of $45 billion. They're growing earnings or EPS, and the revenue looks like stairs. Looks stairs also. Wow, look at that margin in the year of 2025. Good for this company. Where are they located? Comfort USA Systems. I know Comfort. I just didn't know they were publicly traded. I bet you Kramer knew. Comfort Systems USA is headquartered in Houston, Texas. I'll have to ask my friends that live in Houston, what's the deal with comfort, guys? What's the deal with these guys? I mean, are they really supposed to be trading at this high of a valuation? Maybe they're not trading at a high valuation. I'd have to check. Maybe we put comfort systems, we come back to it. See, I don't know if anybody's watching the podcast, and I don't do a live show, so I don't know if people want to talk about comfort systems or if you're interested in it and you want me to do more research on it, just send me a comment. Okay. Last thing I wanted to discuss was my watch list. Yesterday, I showed you my watch. I show you my watch list every day. I'll probably not buy more Palantir. I thought if Palantir sold off 80%, I would buy more, but I don't know if I would. And waste management, we talked about. If I were a trader, I'm not a trader. I don't know anything about trading. But if I were a trader, or if I were an institutional investor, hedge fund manager, I don't know. I find it interesting that waste management looks it's about to break out. I mean, isn't waste management already too expensive? XLE, we're looking at how their stocks, how the energy sector is doing. And I own a little bit of XLE. I own a bit of, so let me back up. My 2026 watch list, I own most of these stocks already. So they would be just ads for me. So it's stocks I'm focused on a little bit more, but that's not how it works. If Google dropped for some reason that didn't make sense and they were down 30% from all-time highs, for example, I would probably want to buy Google, Alphabet stock. If I did the research, understood why it was selling off, realized it was being overdone, and that the news wasn't as bad as it was, and Google was going to survive this and come out great. That's when you buy Google. Google's not on my watch list, but I don't need it on my watch list, right? Because it'll be in the headlines, it'll be in the news. I'll know everything about it already, about the story. I have Spotify in here, which I don't own. I had Spotify. I sold it for a smaller gain, a 25% gain last year. It wasn't my intention to sell. I just had to come up with a little more cash at the moment. I normally don't sell stocks. I buy them more than I sell them because I'm younger and I'm a buy and hold investor. Berkshire Hathaway, we keep talking about this stock. I'm not going to buy it yet. Greg Abel's buying Berkshire Hathaway stock. QQQ. Interesting that continues to lose steam. I think the QQQ, we have to see what it does around here in between the 50 and 200 day. Again, I'm not a trader. If the QQQ sold off in a bear market when the S&P is down 20% and the QQQ is down 30%, I buy QQQ. That's when I step in and buy it. We talked about freedom. Meta's in here just because I think Meta is a cash cow and a good stock for the future. I think Mark Zuckerberg's underrated. I think that I want to buy this stock with way more pain. So I keep it on my watch list. I own it already. American Express. I mean, it's asking us to enter here. It's asking buyers to enter here. Like I said, American Express is a tricky one for me. I don't own the stock. If I'm going to buy it, I want to see them waving the white flag that they're frightened and that the market's frightened about American Express. It's obviously has this headline risk of white collar job losses. That's a big one. Stagflation does not want stagflation. Bitcoin is always on my watch list. Bitcoin is my favorite investment of all time. It's my favorite asset of all time. Other than the NASDAQ 100, it's my favorite investment. I think people that shit talk Bitcoin they haven't done the research. And then I just added Goldman Sachs to my watch list last night because I didn't realize it was on this much of a sell-off. So we're starting to trade down to the 200-day, obviously, because there's fear in the market. There is speculation that they won't be doing as many IPOs this year, or there'll be a freeze on these big companies coming out to IPO because it's a bear market or something. I have to do a little more research on Goldman Sachs before I take a position, so I might not beat this sell-off. And look at the tear it's been on. I think these stocks are financials in general. The Goldman's, the JP Morgan, I think they were due for a healthy pullback, but you don't want to, it's not a, not, it doesn't make you feel good when financials sell off this. It tells you that there's some underlying concern here, but it could just be a normal correction. But some of these stocks are getting pounded, and I added Goldman Sachs because I would assume Goldman Sachs is a good company, and I'll do more research on Goldman's. Let me know what you think about Goldman Sachs, if you guys have any interest in this company. And I mean, this is a buy and hold investment. American Express, Goldman Sachs are one of those stocks, in my opinion, that those blue chip type of financial stocks, you buy them once and you never sell them and you never buy them again. You just buy them when it's March 2020, or it's a GFC situation, or it's a pretty bad bear market. You buy it once and then you forget it. That's what I see these Goldman Sachs, American Express type of stocks. And then I also added TransDigm again back to the watch list. I own TransDigm. I think that TransDigm is really super interesting of a company. This is let's read it so I'm not messing up. TransDigm Group engages in the design, production, and supply of aircraft components. They have a monopoly because they have purchased so many companies in their competitive realm that if you have a commercial airplane, you need to buy from TransDigm at this point. You need to be serviced by them. It's all regulatory approved. And obviously TransDigm also has exposure to defense manufacturing too. But there is definitely, this company is, in my opinion, here to stay. They're never going to go anywhere. I mean, the market has rewarded them because of all of their buybacks and their aggressive M&A. Look at this chart from 2007. They have earned themselves to be a compounder throughout the years, but there are periods of times where they get stuck, where they're buying maybe a little too many companies, and the market is concerned about maybe the debt they have on the balance sheet because the interest rates are higher right now and they got to get through this merger and get that debt off the balance sheet. And there are periods of times where maybe it just doesn't grow as much because it's in some cycle where it's adding to businesses, and then all of a sudden they'll buy a business, and all of a sudden the business they own, those margins go up. I don't know if it's because they raise pricing or not, but they get away with it. And you have to understand what you own. Look at this. For the year 2025, the revenue was 8.83 billion and their net margin was 21%. And this is an industrial manufacturer. It's crazy. Lockheed Martin, whoops. Lockheed Martin. And by the way, I'm just looking at TradingView because it's easier. I wouldn't, if I'm doing real research, I don't use TradingView as my data because there's too many mistakes. For example, Lockheed Martin, their revenue was 75 billion, but their net margin was 6.69%. So TransDigm Group, check it out. I mean, it's giving you a gift that it's consolidating this long, and it makes me think that this stock is not breaking for a reason. There's a group of institutional or management that there's just a group here of investors that don't sell this stock. And this consolidation has gone on since April 2024. We're now in the year 2026. And TransDigm pays a dividend as well, right? TransDigm pays a dividend. Yeah, definitely don't get your data from TradingView. TradingView is just good for charts. It's saying it doesn't pay a dividend. I don't know. I think they might pay a special dividend if I'm correct. So anyway, this is the type of stocks we're looking at. I'm not trying to cherry pick the bottom on SaaS stocks. And I know SaaS has had a dead cat bounce. I know Salesforce has had a bounce. Where would I look here? BlackRock is selling off. They were in the headlines yesterday. I didn't really understand the story. I guess they had an issue with one of the private companies they own. Private credit's getting whacked, I'm guessing. Bitcoin selling off nicely. AppLovin and Meta are selling off. The VIX, wow, look at the VIX, guys. Yeah, But you're telling me that you don't think the market's a buy? I had the VIX around 28. If it breaks this green line I have here, I guess it's some resistance line. True. Don't go by my lines. Again, I'm not a trader, but you break this, then you're in crazy territory for the VIX, and it's probably a time. But the major indexes just don't sell off. That's the scary part. Is I'd rather buy when the S&P is in a bear market or is in a correction. The S&P, because we're in such a diversified and all those stocks, Caterpillar, and they just did so well. And it's just a very tricky situation. And regardless of volatility, and that's volatility in the derivative market. Look at the QQQ. The QQQ is, I mean, to me, it's barely down. So I would be cautious. I'm not, since the US Israel, sorry, since the US Iran war, the new one, as of 7 days ago, I started this podcast and I haven't bought or sold anything. It's not that I'm frozen in fear, it's because I don't trade and I don't see anything really out there right now. I would just see more pain and something to go. I'll do more research on Goldman Sachs. I'll do more research on American Express. I'll recheck that information and I'll look at those type of companies right now. It looks financials could be nearing a bottom. And I don't know. I'm not really that bearish. Are you guys? I got to apologize too if you actually are still listening. So, an app that's trying to edit all my pauses and then it's supposed to edit my ums. So, I guess that just got edited out. And it's really not working out well for me. It's cutting my podcast. I'm saying stuff and it's cutting it out. So, my whole apology here is I promise I will get better and I'll try to get this fixed. I don't plan on stopping the podcast anytime soon. I hope I can always do it, but I will try to make it better. And so sorry if it sounds choppy. To me, it really bothers the crap out of me. And I've sent it to friends and family, and they're just, oh, I don't notice anything. You sound great, but I can't stand it. So I will try to make that better. Thank you for watching, and please drop a comment and let me know what you guys think of the show. I know I don't have fireworks and nice lighting and all that. That's not the point of the show. It's supposed to just talk about the headlines and what it means for long-term investors. And that's about it. All right. Thank you so much for watching. Take care. Bye.